Hey, this is Sasha. Thanks for joining me in today's video. What I want to share with you today is 3 different ways to set up bullish call vertical spread. So I'm going to show you these 3 different ways and setups so that way you can get an idea of what the pros and cons are of each. So stay tuned. We're going to cover these 3 right now. All right, so for a lot of people getting started into option trading, they're really looking into, hey, how do I go ahead and buy a single call, then buy a single put, and then eventually they get into vertical spreads. However, you got to understand that there's different types of trades that are better for certain situations. It's not that one is better than the other. It's just that, hey, this one's a little bit better in this case, that one's a little bit better in that case. So that's what I'm going to share with you today is just 3 different ways to set up these vertical spreads. Of course, there's all kinds of combinations that you could do with them. And as you start layering one on top of the other, you could convert them into iron condors and then layering into really weird iron condors, which I'll show you at the end. So here we go. Let me show you on paper here, kind of the 3 different vertical spreads. And you may say, hey, these look really similar. Well, they're really not. They are completely different, one than the other. So what's really the big difference? Well, here in this case, when I look at it, price is going to be right here. So this is going to be a balanced vertical spread where about 50% of what you risk, you will make 50% of that. Okay, in this case, you're risking very, very little to make a lot. How does this work? Well, in this case, what's happening is price is all the way over here, so you need price to really move in order for you to profit. And then you've got the other case where, hey, you're risking a whole lot of money over here, okay? But you're only making just a tiny bit. So why would you want to go in this? Well, in this case, price is starting out in here. So here's the big difference is price stands still, you make money. Price goes up, you make money. Price goes down, you still make money up to this point. In this case, you need price to really move. In this case, you need it to move a little bit and stay there. So that's kind of the 3 big differences. This one is at the money. Okay. This one is out of the money. And this one is, you could say, hey, it's selling a vertical actually. So selling put vertical. So it's in fact a little backwards than what we talked about with the call, but you get the same kind of profit picture or risk reward style. So if you don't know what a vertical really is right now, I just want to break it down for you. Really what you're doing is you're buying one option, you buy one, and you sell one. Okay. In our case, what we're doing is we go ahead and depending on how this is set up, this creates this profit picture. Okay. So let me show you here on screen how this works and just to show you how this full combination really plays a big role. So as we take a look at, I'm going to go ahead and take a look at Home Depot here. So I went into my TD Ameritrade platform here. This is the trade area. We'll go to Home Depot. And let's say we are going, right now Home Depot is at 240, just so you get an idea of where the chart is. We're way up here. Stock's been going up for a while. So there it is. There's the 240. So I'll go back and we will go 57 days out. Okay, so you can see here, this is the call side. I will do the easiest one first that we started with, 57 days out. Okay, and you can do this 37 days out. You can do it 29 days out. Can you get out of it early? Yeah, you can as well. If it moves in your favor and then you get out of it, you can do that. I'm going to go ahead and put these in as single orders. So that way you understand how it works. And then the next few, we'll go ahead and put them in as a spread. So what I'm going to do is first, I'm going to go ahead and let's say buy one for protection. Okay. And I'm going to buy one. We're going to play with this kind of at the money zone. Okay. Now at the money is going to be right here, this 240 area. But I'm going to play kind of right in this zone because I need a couple of different strikes. So really what I'm doing is, let's say I buy the 230, just to show you the example, I'm going to buy a single here. Okay, and now what I've done is I've got this single contract. Okay, my problem here is I've got this time decay. I'm losing $8 a day. And it cost me $17.20 to be able to put this trade on. So how do I reduce that risk? Well, why don't I sell one above it? Because, hey, we expect the stock to head higher. I just don't expect it to go to the moon. That's really what you're saying here. So what I want to do is I will go ahead and buy one for right here at 1660, and I'll sell another one maybe at, let's say, the 255. You could do the 250. Let's say the 255. Okay, so I sell one. Right here we sell a single, just so you can see. And now what I've got is a spread that looks like this. Let me get rid of these other slices for you so you can see what it looks like. So there we go. We got kind of a balanced 50-50 spread. So I am buying one at 17.20, selling one at 4.30. So net, what's happening is instead of me paying 17.20, which is the price here of buying the option contract, what I do is reduce my risk right here, and now I only have to pay about $12.90 because I get that extra $4.30, or in other words, $430. Now, what can I make here? Well, if the stock goes up in my favor, I can make $1,210 on risk of $1,290. So looking at this spread and situation, you can see $1,290, you can make $1,210. So 50-50, you make 1-to-1. But the problem is you got to have the stock move up a little bit and then hold there and then expire there. That's how you make your full potential. The white line is today, the green line is at expiration. So slowly with time, that white line will get closer to your expiration. Okay, and that's really what we're doing with this spread construction. So that's one way to set up kind of a vertical spread. You kind of balance 50-50. If we look at kind of this other situation, out of the money, this is what some people really like to do. And when you look at this situation, what's happening is I will shift this to out of the money. Okay, and the way that I'll do this, I'll put this in as a single order. Instead of kind of playing in this range around the 230, 250 level, okay, so that's kind of where we were playing right now. I'm going to go ahead and play around the 275, 285 level. So I'm going further out. What is that going to do? Well, the prices are cheaper further out. And because these prices are way cheaper, take a look. Because these are closer to at the money, these are 805. If I go further out, these are only 80 cents. So it makes it a lot cheaper for me to play a directional bet. Unfortunately, the downside is, well, you need that stock to move much more. But let me show you how this works. So I'll go ahead and in this case, I'll just buy a vertical, and we'll just go ahead and put it in as a single order. And now what you can see is, we'll uncheck the other ones. I'm only risking now, take a look at this. I'm risking $52 to be able to make 448. $52 to make 448. Now, what's the downside? The downside is, number one, I'm losing theta, I'm losing time value. Also, this stock's got to move about, let's say, 10, 20, 30, 40 points for me in 60 days to the upside. So it's got to move in my direction. So if it stands still, I lose. If it pulls back, I lose. If it moves up a little bit, I kind of can win if it does it quickly, but otherwise I will lose. It's got to move up quite a bit for me to be profitable in this trade. But I'm only risking about $52. And that's because, hey, the probabilities are not in my favor. It's kind of like, hey, you got a 10% shot and or maybe a 5% shot, depending on the probabilities of these trades. So you've got like your low chance of success, but you can make quite a bit of money. You can make, almost 10 times, 9 times your money or so, just by doing kind of the spread if it works in your favor, but it's a low chance of success. And then here, what we do is do a different one. So the third way is, let's just go in and check it out, is selling a put vertical, which gives you very, very tiny bit of profit and you put on a lot of capital. Now, why would somebody do something like this? Well, it's because your chance of success could be more like 80% chance of success. This might be, just to show you, you've got a, let's say, 5% chance of success here, okay, to be able to make, let's say, 5x your money. This one, you got almost a 90% chance of success, okay, but you can still make about, let's say, 5 to 10% of your money. Which would you rather have? Everybody's a little different, but I'll tell you, money managers usually focus on something like this because it's a high success rate. We're looking for success rate. So this is what I'm going to show you right now. And just to show you here, if we go in and let's just go into our deltas here. Let's say I sell the 210. So what does this mean? Well, it's very similar to opposite of buying a puts, which means we're a seller. You can see here we've got a vertical. Now, I only make in this trade setup, I'm not making a lot. You could say, hey, he's making pennies. He's only making $64 on how much capital? 436. So not a lot. And if I go ahead and sell 2 or maybe 3 of these, okay, if I sell 3 of these, I only make about $192 on 1308. 192 on 1308. Is that still worthwhile? Well, the chance of success here is way higher. And that's why a lot of the money managers, they love these kinds of trade setups, is because of that success rate. So when you look at the, let's just pull up a calculator here real quick. 192 on 1308, you get still 14%. So are you happy with 14% when it's like a 90% chance of success? This is what typically most professionals kind of go for, is I'd rather have a high chance of success. So this is the third way to do it, to set up a vertical. Here, a stock stands still, you make money. Stock goes up, you make money. Stock pulls back, you still make money as long as it stays above that level, your 210, which is what you chose on the short strike. So making a little bit of profit with a high degree and chance of success is typically the smarter route that many people kind of take. So anyways, those are kind of the 3 ways that I would look at if you're looking to, upside movements in any stock. You're looking for these 3 ways. The first is kind of 50-50 balanced. Then you look out of the money, which is really directional, and then selling a put vertical, which still gives you a bullish upside movement. And once you get a little bit better, what you could do is create some really crazy spreads. So you could see this one, as I'll show you. I've got this put spread that was created here in Netflix. This one is a 1 contract and a 1 contract. There's the put spread. And you can see I'm making on this one $143 right there. There's about 143 on 1285 on this one. Okay. And then I've added other put spreads here on this vertical on the call side. And then I've added another one here on the call side. So together we've created this weird iron condor, but all just using verticals. And that's really the construction. And I think this is the smarter approach when you're looking to do things, is really creating these spreads. And that's a better construction. And I would highly recommend and encourage you to start investigating these kinds of spreads and potentials, because that's the better route to trade rather than buying a single put or buying a single call. Even a vertical, you're really way stepping up your game right there. But if you really want to learn how to do this properly, you could check out the Getting Started Options Trading 101 on our website. There we have a lot of introduction videos for you. And if you're interested, you can check out some of the really detailed courses that we also have, like the Business of Verticals here. This Business of Verticals course is very detailed and lengthy. So when you look at this course, we've got this course, I think it's like 20 hours long. So there's a lot of modules in here. And, when you budget it out on a per hour basis, it's about $20 per hour. There's 22 hours, 35 videos, definitely worthwhile, to getting started. And there's more about iron condors, calendars, definitely a lot of things you could check out. And if you want to look at some of the coaching that I do, you can also look at it there on our website as well. Anyways, thank you so much for joining me. Hope you enjoyed this video. Don't forget to subscribe to the channel by clicking the link over here. You can also download some of those freebies that I have by clicking, this watch now button there, and also going in and watching some more videos on YouTube on this side. Thank you so much. And remember to do what you love, contribute to others, but most importantly, live life abundantly. I will see you next time.